let's do some more fundamental analysis. We're going to do that with Barry Bannister, Stifel, Chief Equity Strategist. Barry, we'd love to get your thoughts. In the last few days, we've had strategists from Deutsche Bank raise their year-end price target on the S&P to a 4,100. You're eyeing, I believe, a 3,800. What is the path downwards to a 3,800?
A lot of it's going to depend on whether the real yield is allowed to normalize a little bit by the Federal Reserve. That's why tomorrow's meeting is the key determinant of the market. A real yield that's rising signifies growth. You get from this over-the-top excessive fiscal stimulus, you want a higher real yield, and that would offset the declining risk premia in the market, and as a consequence, the market would flatten out. That's a healthy thing. But if the Fed represses the real yield, I think it's going to be a disaster. We would have a huge bubble up and then a bust like we have in the past, and they would be making a tremendous mistake to repress the real yield overtly.
So you're hoping for no comment, let it rise. And indeed, I mean, Citi yesterday we were hearing saying if the real yield did get to perhaps the zero bound, for example, we could have another 10, 20% increase, relatively speaking, of value versus growth. For you, does that still continue even if the Fed doesn't sort of put a kibosh on where yields are going at the moment?
Well, I mean, the Fed can extend the SLR, which is the liquidity requirement for the banks, so the banks don't have to turn around and sell their treasuries and drive yields up. But that at the margin is a fairly small effect. I think that would be wise. They should do that. But they shouldn't sound that note of, like, we stand behind repressing the real yield, because we are at the doorstep of a bubble. We could potentially have a bubble if the Fed represses the real yield and the risk-on decline of the equity risk premium continues. It's a very powerful mathematical formula that drives the market higher. We could easily add 1,000 points in a matter of months to the S&P if the Fed makes that mistake. They should not step on the real yield, the TIPS yield.
Let's talk a bit about where we stand right now in the S&P 500. We hit those record highs, and we sort of reset on those highs. And now we kind of seem like you have a market that's a little bit indecisive. They obviously want to see what the Fed's going to do. They're obviously keeping an eye on those real yields here. But there's also keeping an eye on those multiples. And I'm curious as to kind of where you see things shaking out here, given the backdrop of what we know, or at least what we think we know right now.
Right. We look at Shiller's CAPE, except we use operating earnings or its substitute going way back. So we look at the operating earnings 10-year average, inflation adjusted of the S&P, and that's about $128 this year. So the market's trading over 31 times that. Now, there has been an uptrend in yields over the last 20, 50, and 100 years. You have to accept that. We know why it happened. But within that uptrend, we are at the doorstep, right at the doorstep of beginning a possible 10 multiple point increase on the CAPE. That's add 1,280 points to the S&P. The only times that ever happened was 1928-29 and 1998-99, and neither one ended well. So the Fed better not drive a bubble, because all bubbles burst. And we see speculative activity all around us. Just look at the digital art and the Bitcoin and the SPACs and the craziness going on in the market today. So the Fed really doesn't need to encourage this.
All right, we're speaking here with Barry Bannister, Chief Equity Strategist over at Stifel. He's sticking with us as we count you down to the close. Less than 5 minutes to go. Taylor, you're at the board.
Big comments from Barry, so let me keep this short and sweet, Romaine. It is Lending Club. Kathy Wood has added this company to her ARC FinTech ETF. This is fueling at one point earlier today the biggest 5-day rally ever for this stock. So this is certainly something that we're watching. And finally, let's flip up the board. And Barry, I'd love to bring you back in here. We're on track for the VIX to close below 20. You go back, it did that once in February. Besides that, it hasn't closed below 20 since March of 2020. What does the VIX below 20 tell you for your equity markets?
One of the things that we do is we overlay the VIX against the global money supply. We use global M2 on your Bloomberg. It's .glmosupp index proxy go. And you do the year-over-year change of the global M2 money, right? And it typically peaks in the last 15 years at 20% year-over-year. It recently peaked there. As it decelerates, let's say to 10%, the market tends to flatten out. But on the way up, the market does double-digit annualized returns. So when we see money supply growth roll over, historically the VIX rises, the volatility increases, and the S&P starts to flatten out. And I think that's what's going to happen. But again, if they pour all this money into the market, do more QE, repress the real yield, we will get a bubble, and that bubble will burst. And it burst in 29, and it burst in 99, early 2000, and it's going to be damaging.
Barry, given the valuations, are we not already in a bubble from your perspective?
Well, the bubble is like climbing the stairs, right? We're on the first landing. We've definitely gone up one rung of stairs. But to actually get to a bubble, we'd have to be looking at like 40 times CAPE trailing 10-year real operating earnings, or 40 times 128. And, I saw that Dalio did a piece recently. His bubble meter was at the 75% measure. Our measure is that we are at the 75% of a bubble being around 5,250. So I would agree with that we are climbing towards a bubble, but we haven't gone parabolic yet. And that could happen if they make a mistake and let the real yield stay repressed.
Barry, down in Washington, they're about to throw a few more logs onto the fire here with regards to economic stimulus, economic relief, whatever you want to call it here. There is some concern here that as much as that money might be needed for a lot of folks on the ground, there are larger concerns here about inflation and about the long-term implications of some of these programs here. How do you factor that into your outlook?
Well, just if you pull up a daily chart of the 10-year yield, it's been on a 0.90 R-squared trend for 30 straight years, down and curving slightly to flat. Okay, so we could easily go by 2022, perhaps, to a 2.5 10-year. If you look at the TIPS yield, like I mentioned, it was as low as -1. The market PE was in the 30s. And this is on trailing earnings. It's probably going to go to about 0 to -0.25, and that would push downward pressure on the PE against upward earnings and keep the market from rising. So your question is, what about inflation? 10-year minus TIPS is break-evens. We've got break-even inflation, probably 2.25 plus or minus a quarter, stabilizing. The fiscal is excessive. It was a big political giveaway. It really wasn't a lot of money that's going to immediately go into the system. Okay, so a lot of it was long-tailed money like pension fund bailouts.
Yeah.
And as a consequence, you really have to look at the part that's high velocity, the money that's going to go right into the system, like the stimulus check. And that's going to be here. That's going to have an effect. It's going to supercharge the economy into the next quarter.
Barry, with all the shout-outs for what you should be using on your Bloomberg terminal, we love it. Barry Bannister, Stifel, Chief Equity Strategist, we thank you for the perspective. Yeah. All things bubbles today. Meanwhile, we're looking to remain
at... Caroline. It was very telling.
I was running them all.
Yeah, okay.
Yeah, no, yeah, exactly. Just simultaneously typing them all in.